Hey YouTube family, welcome to another video of the Kevin Strong Show. And in this video, we're going to talk about mortgage demand sinks even as rates drop. And I'm here to tell you lower interest rates will not save this housing market. And I have proof, and it basically never really has. I have a chart that goes way back to 1980. I'm going to share that with you, so please stick around for that information. If you do enjoy this type of content, please do me the great honor of commenting, like, and share because I care. Hit that subscribe button. So without further ado, let's go ahead and jump into this here. Once again, the title of this particular article we're going to talk about today is called Mortgage Demand Sinks Even as Rates Drop. So the first point I want to bring up to you regarding this topic in this article is that mortgage rates drop for the second week in a row, but that didn't revive demand from homeowners or potential buyers. So obviously that makes sense because the second point down here says, hey, the 30-year fixed rate just moved down from 5.84% down to 5.74. So there's a lot of people last year that refinanced and locked in at really, really good stellar rates. You know, some people got below 3% 30-year fixed rates, which is obviously well below inflation. So kudos for those people who've done that. But if they bought a house at the top of the market, that's another conversation. But specifically from an interest rate perspective, that's a great rate to lock in for a 30-year fixed rate. So the only time somebody would be compelled to give that up and jump up to 5.74%, especially if you've got a $400,000 mortgage or higher. I think the average mortgage balance in the United States in aggregate is somewhere around 400,000. You'd have to have a crap load, and I do mean a crap load of debt, right? So your payment would go up astronomically, just not factoring in anything else. Just imagine how much your payment would go up from, let's say, 3% to a 5.74% just rate and term. You know, it might go up, $1,200, $1,300, quite a bit on a $400,000 loan balance. So the only reason I could see somebody deciding to do that is if they had a lot of debt with the high interest rate, $30,000, $40,000, $50,000 with the credit card debt, paying that back at 25%. It could make sense at that point in time to roll all of that debt into a new 30-year fixed mortgage, even at a 5.74%. But because of all of that debt is being amortized over a 30-year period, it could come down to a substantial savings in terms of you just never being able to pay off those credit cards because of the high interest rate. But that's the only scenario that I would see somebody would be in a situation to have to do that. But that could be forthcoming, as in my opinion. We're definitely in a recession, and that's going to result in people losing their jobs. And if you can't make your payments, and then all of a sudden creditors are knocking at your door or threatening to sue you, you could be compelled to jump on that higher interest rate. So enough about that. Let's jump down into the article a little bit more. There's a point down here that I wanted to pick up before I get into my charts. And let's see here if I can find this. Here it is. Okay. Sorry about that delay. We're doing this live. Home purchase applications also fell for the week and the year, down 4% and 17% respectively. So basically they're saying week over week from the previous week, they were down 4% and year over year was down 17% respectively. So why do I have this particular part of the article highlighted? Because think about it, year over year, 17% down, but we're in July. This is supposed to be when housing is at its best, right? Housing kind of kicks off the season in April, and it slows down as you get towards the latter part in fall, and definitely during the winter months. You don't have as much housing activity. But the fact that we're down 17% is a very ominous tale. They say things are probably going to get a lot worse before they get better. So at the start of this video, I had a tease for you guys. I said, hey, stick with me because I'm going to show you some information that proves that as interest rates go down, it doesn't help the housing market. So let's jump into that. Let's see here. Okay, there we go. You guys should be, I'm loving this. I've got this new internet connection. I had to turn in an old box, and I think that's why my audio was lagging a little bit. My videos were lagging. So Anyway, let's go ahead and talk about this. So this is Federal Reserve Economic Data, okay? The acronym for FRED. 30-year fixed rate mortgage average in the United States. This thing goes way back to 1971. Okay, this is not my editorial. I'm gonna analyze and share with you data points that go back well over 50 years. So these vertical bars, right, typically indicate over 90% of the time a recession. So let's start off in 1980. Things were going good, and then bang, what happened? We hit a recession. Keep in mind, these gray horizontal bars, I'm gonna keep saying horizontal, but vertical. I stand corrected, vertical. Vertical. Up and down is vertical, Kevin. See, look here, folks. The interest rate were going down, even during a recession, because that's what happens. What happens is that the financial institutions can no longer lend money, specifically mortgages, at higher rates. So they have to lower the rates. Banks make their money when people pay back their mortgage. That's probably one of the primary revenue sources for most financial institutions in the United States. So they can only keep rates high for so long, and then rates have to come back down in order to spark demand. It's a simple supply and demand equation. Let's go to 1990. Once again, look at this vertical gray bar. We hit a recession in 1990, and what happened? Rates had to come down in order to spark demand. Let's go to the next one. This is during the so-called dot-com bubble. This is when all these companies had all these crazy valuations that weren't even making profit. It was just, if you had abcpets.com or something, and you had a cool website, they had an evaluation of, $1.2 million. I was an online business consultant for a company in Solon, Ohio, and it was just crazy. And then when that bubble popped, everybody in that industry basically had to get another job. But as you can see, when that dot-com bubble happened, what happened? Rates went down. To the great financial crisis, right? They call it the GFC. So process as it applies to this last, we had around July of 2006. And it didn't really bottom out till like December of 2012, or the fourth quarter of 2012. So the housing crash started and ended, and it took 6 years. It's a process. This next one is not going to take that long. It might only take 2 to 3 years, half the time. That's just in my humble opinion. But getting back to the chart, as you can see, even in 2008, when we had this great financial crisis, what happened? A bunch of inventory came up. They start lowering interest rates. Interest rates got as low as under 4% back then, 3.88. And guess what? The housing market didn't turn around. It turned around in the latter half of 2012. But once again, as you can see, we went years of lowering interest rates. Once again, we're talking about the 30-year fixed mortgage average in the United States. This is not my opinion. This is documented facts. Even though interest rates were going down for years, it did not stop the housing carnage. Going to 2020, when we had the health crisis, we were due to have a recession then. We got put in a lockdown. I have to be careful with my words here. There was a lot of quantitative easing that artificially pumped up the stock market as well as the housing market. And what do you see right now? We're up at 5.74, and rates haven't been this high since around 2008. Okay, 14 years roughly. So as we go into a recession, which we are in right now, which is 2 negative prints of gross domestic product back to back, they're going to call it. Guess what's going to happen? Interest rates are probably going to start to come down, and they might come down quite a bit. But guess what? Historically speaking, as I've showed here with proof, it doesn't save the housing market. Okay, in a recession, what happens? Employers don't feel confident. They start to lay off. You have something called the wealth effect, right? People start losing money in the stock market. People start hearing about massive layoffs. They don't feel confident about their economic security long term. Why would the average person go out and make a purchase of a home and lock in for a 30-year debt obligation? They're not going to do it. So too many people are focusing on inventory, wealth effect, and people not feeling comfortable about the economic outlook and things has a lot to do with supply and demand. It's not just about, well, Kevin, it's all about inventory. And as long as inventory is low, then the housing market's going to stabilize. No, it's not. We have a crap load more debt now than we had back in 2008. We have more consumer debt now than we've ever had in the history of this country. We're at 40 and 50-year highs when it comes to inflation. We're slowly entering into a global recession, and some people even think a depression. So all of the aforementioned are way more ominous and putting more weight on the consumer's back now than ever before in 2008. So all of you who are coming out of the woodwork with this myopic viewpoint about just interest rates only and inventory are missing the bigger picture. The average recession typically lasts about 11 months. The one in 2008, if I'm not mistaken, lasts about 18 months. So we thought we're getting ready to run into a depression. The financial system was getting ready to collapse, and that's why the government intervened and started quantitative easing. A depression is basically worse than a recession because that lasts multiple years. To go back to 1929, that particular depression started around 1929. I think we came out of it in 1954. If you factor in inflation, the money you lost in 1929, when you factor in inflation, it took you almost 40 years to get it back. If you miscalculate your money this time around, you might be taking a serious dirt nap before you ever get your money back. Okay, without further ado, I'm going to show you this last chart as promised here. So let me go ahead and share my screen again. And let's see here. Oh, I love this new internet thing. This thing is just whizzing along. I don't look like Sanford and Son when I do my videos. Hopefully my subscribers base will go up. Help a brother out. All right, this is the University of Michigan consumer sentiment, okay? Once again, you see these vertical bars basically indicating a recession. So in layman's terms, what this chart represents, do you feel good or do you feel bad, homie? How you feeling, right? So as you can see, as you went into a recession, consumer sentiment goes down. People don't feel as optimistic and healthy about the overall conditions. And then when you don't feel healthy about the overall economic conditions, you don't make purchases. Unemployment ticks up, layoffs ensue, people aren't buying houses. Same thing in 2009, 2020. Remember, the other chart I gave you was the average 30-year rate chart, right? Average over the United States. But if you overlaid that chart with this one, you would kind of see it follow it in sync almost. Because consumer sentiment has a lot to do with the housing market. It has a lot to do with it. Look in 2008, everybody was experiencing irrational exuberance, thought the housing market was going to go up forever. What happened? We went into a recession. See the vertical gray bars? And as a result, think of the other chart. Interest rates were going down, but despite interest rates going down, consumer sentiment still stayed down. It came back up a little bit and it came back down again. And then it didn't really start to pick up and take off in 2012. And what did I tell you guys in the other video? In the other graph? The housing market started to rebound in 2012. And that's matches exactly what we have here when it comes to consumer sentiment. So as you can see how I nicely put that together, that how the 30-year fixed rate mortgages kind of move in concert with consumer sentiment. And obviously we're at this part where we're getting ready to go into a recession again. More than likely, you can pretty much figure out what is going to happen. So I hope you enjoyed this video. Once again, if you're enjoying this type of content, please do me the honor, comment, like, and share because I care. This was the Kevin Strong Show, and I'll see you guys in the next video.